We sued them because they're violating something called the Government in the Sunshine Act of 1976. It is political for a whole host of reasons. The ultimate reason we could talk about first is that the Federal Reserve is a deeply compromised institution. They're a one-sided ideological institution. Now, today, only 15% of 30-year-olds own a home and are married. That is the most important, depressing statistic. The truth is, this is the most transformative technology. It makes the internet look like a milestone, a small incremental step.
Welcome everyone, this is Mariusz Konieczny. I am chatting with James Fishback, the CEO of Azoria ETF. James, thank you very much for joining me.
My pleasure.
Okay, so let's start off. If you could maybe take a few minutes to introduce yourself, who you are, maybe your ETF, investment style. We'll talk about interest rates, the economy, Trump. We'll have a good time. Let's go.
Wonderful. I grew up in Florida. That's where I grew up. That's where I still live to this day. And I've always had a passion for economics. I was on the high school debate team many, many moons ago, 15 years ago. A real passion for what was going on in the country. I went on to college in Washington, D.C., the nation's capital, of course. Started doing research on FX volatility and interest rate volatility. And I actually dropped out after my sophomore year of college at Georgetown to start a hedge fund that I called Macrovoyant. I did that for 5 years, and then I joined another hedge fund called Greenlight Capital, a multi-billion-dollar hedge fund based in New York, where I was a macro trader. And so I've spent the last decade really steeped in the world of what's called global macro investing. So most investing is bottom up. You look at a particular company, look at the fundamentals, and then make a decision to buy or sell. The approach that I've taken is looking top down, look at entire economies, entire geographies, big picture questions like, what's the Fed going to do at the next meeting in a week? What is the inflation picture going to look like a year from now? What impact, if any, are tariffs going to have on growth and reshoring, et cetera? And so that's the approach that I've taken to investing. I left the hedge fund I was at last year to start Azoria. Azoria is what we call a free-thinking investment firm. And we call ourselves free-thinking for the same reason I think you can appreciate that the world of investing has a lot of people that subscribe to groupthink, that end up just following what the trend is or end up agreeing with whatever the consensus may be peddling at that particular moment in time. And so what we've really built Azoria on is rigorous thinking, independent thinking, free thinking, that we don't just take a conclusion because it came from Goldman Sachs. We take a conclusion because it may have come from elsewhere, but we have rigorously tested it in-house to decide, okay, this theory makes sense, whether it's on inflation, on tariffs, or on individual companies' prospects. And that's what we've been building. Our first ETF is already trading on the New York Stock Exchange. It's called SPXM. That's the ticker, and it's the Azoria 500 Meritocracy ETF. And Mariusz, the way it works is it is the same 500 companies in the S&P 500 from BlackRock or Vanguard or State Street, with one exception. It excludes the 38 companies in the S&P 500 that have DEI hiring quotas. And what is a DEI hiring quota? Well, Starbucks has them, Airbnb, Intel, and others. And a DEI hiring quota, very simply, is a company coming out and saying, we intend to hire X percentage of Y race. So Starbucks says this, we want 35% of our baristas to be ethnically diverse. And ask yourself, what on earth does ethnic diversity have to do with selling a good cup of coffee at a profit? What's happened since 2020 is many companies have been infected with this orthodoxy that says that, no, we don't have to worry about hiring the best and brightest. We actually have to hire for a social agenda. And that social agenda is to make up for what they would argue is decades of racism or systemic injustices, pushing an agenda that has nothing to do with shareholders. And what our research at Azoria has found is that companies with DEI quotas over the last 2 years, just one example, they have underperformed the stock market, the S&P 500, by a whopping 19 percentage points. And you could imagine why they've underperformed. When a company throws hiring standards out the window in an attempt to outwoke the competition, what they'll end up doing is they won't hire people who are qualified. They will hire people who are not yet qualified but meet their arbitrary definition of diversity. And lastly, when they do both of those things, they create a workplace where there is a deep sense of mistrust and distrust. People are constantly looking over their shoulders, wondering, Was I hired because of my race, or were they hired because of their race? And that affects workplace belonging and cohesion, which hurts productivity. It increases attrition. It makes it harder for folks to contribute to the mission. And so that's just one example of the products that we've launched at Azoria. We've got a couple more coming out. The Tesla Convexity Fund is an options-based Tesla ETF that allows you to be both long Tesla, the stock, but also long, cheap call options on Tesla, the stock as well. And that's been really exciting. And then our flagship product coming out later this month as well is called the Azoria Golden Age ETF. And that is the top 25 golden age companies that are pioneers in manufacturing, in generative AI, in real world AI, in American energy, to, we think, really benefit from this new era of American exceptionalism.
Wow. When did you launch your ETF company?
We launched Azoria at Mar-a-Lago, of all places, in December of 2024. The president was there, Cathie Wood, a lot of other great folks. We launched it then, and then the first ETF, the anti-DEI SPXM, that went live last month, or July 8th.
Wow, wow. That's fascinating. It's fascinating. But I listened to some of your interviews, some of your videos, and you have passionate opinions about the Federal Reserve, interest rates, and I was wondering if you could share your views on those topics with my audience.
Absolutely. I'd be honored, and I have a lot of respect for your audience and what you've built. And the Fed is the most powerful and the least accountable institution in America. Think about that. It is the most powerful. There's a separate debate to be had on why it has so much power, how it's been able to amass this power through mission creep. But the most powerful, without a doubt, and the least accountable is a terrible combination. What do I mean by accountability and transparency? Well, the Fed just met in July. They had a meeting where for the fifth straight time they refused to lower interest rates since President Trump took office. Now, we won't know what was said in that meeting. Not for a year, not for 2 years. We won't know what was said in that meeting for 5 full years. It won't be until 2030 that we know what was said in the July 2025 Federal Reserve meeting, where they decided once again not to lower interest rates. That's bizarre. That's really bizarre. I mean, say what you want about Congress. At least they put it on C-SPAN. Say what you want about the Supreme Court. At least we can see it about C-SPAN. Say what you want about the presidency. At least we can tune in and see it on C-SPAN. And so there's this element that if you're an institution that is doing things in secret, that withholds your transcripts for half a decade, and you have a track record of missing the boat, and in many cases sinking the boat and then missing the boat, that you're in no position to hide from public transparency, accountability, and responsibility. And that's what we've really been focused on. We wrote this article in April about how the President of the United States legally has the right to fire the Fed chair for the same reason that you can dismiss the Treasury Secretary or the now Secretary of War. If you don't think they're doing a good job, the president should also be able to dismiss the Fed chair if they don't think that they are doing a good job. And a lot has happened since then. We've sued the Federal Reserve in federal court. Azoria v. Powell is the Federal Reserve lawsuit. And then, of course, we saw this issue with Lisa.
What did you sue the Fed for?
We sued them over transparency. We sued them because they're violating something called the Government in the Sunshine Act of 1976. Because what did they do? They are hiding from the public. Every other multi-member federal agency has to conduct its business in public. That's the law. After Watergate, Democrats and Republicans in Congress got together and said, look, government transparency is a precondition to our constitutional republic. And if a government agency that has members appointed by the president, confirmed by the Senate, is meeting behind closed doors, the public can never, one, know what they're really doing, but a precondition to being able to criticize your government is knowing what your government is doing. I mean, how could you possibly say that the Fed is doing something wrong if you don't even know what they're doing in the first place? There's this public facade that they throw up, this Potemkin village of ignorance, where they play this game about, well, it was because of inflation, it was because of this, that, and the other. But we don't actually know what those discussions are about. And so our answer has always been, more transparency is better than less. The Washington Post, no fan of President Trump and no fan of conservatives in America, they have written time and again that accountability, rather, democracy dies in darkness. We would paraphrase that: accountability dies in darkness. Responsibility dies in darkness. If the Federal Reserve is proud of its decisions, if they stand by their so-called rigorous economic analysis, if they stand by being independent and being removed from politics and in no way influenced by politics, then they should be more than willing to, one, comply with the law, and two, to conduct their business in public view.
You also talked about how the Fed's refusal to lower interest rates prevents the golden
Yes.
age. Talk about that.
Absolutely. The golden age, hard to know exactly when it started, but if I were to put a date on it, it would have been not November of 2024. I think that was the super cycle of the golden age, which of course was President Trump winning this historic victory. I think the first sign of the golden age was the ChatGPT moment. We all know where we were when that happened, when we first used ChatGPT for the first time. And that was a real revelation and epiphany that this time really was different. And of course, with President Trump coming in and abandoning the broken policies of the Biden-Harris administration that was strangling AI development, the diffusion rule that was holding back companies like NVIDIA, that was a real turning point. What I mean by the golden age is I don't just mean a golden age for tech stocks. I just don't mean a golden age for artificial intelligence. We mean a golden age for Americans, not just those who own stocks, not just those who are predisposed to asset prices going up, but folks like my parents growing up in a working class family. My dad was a bus driver. My mom's an immigrant, a legal immigrant from South America. The golden age is about home ownership. And the American dream is about home ownership. And if people cannot buy a home because mortgage rates are artificially high or being held at 24-year highs because the Fed funds rate is near a 20-year high, that you are being priced out of a home. Now, let's be clear, the mortgage issue, the Fed, is not the only issue that's holding back the housing markets. This suffers from the disease that is multi-causality, from zoning to, I think, private equity firms playing an unnecessary and undue role in single-family housing, and so on. But the Fed, by keeping rates artificially high, and by artificially high, what do I mean by that? I mean there's a neutral rate. And the neutral rate, the Fed will tell you, Mariusz, the Fed will tell you that the neutral rate is about 3%. Our models have it just below 3%. That is the rate, by the way, that is neutral, is natural, that would occur if the Fed were not putting any pressure on the brakes or any pressure on the gas and just wanted to keep things in equilibrium. So why on earth are interest rates at 4.5? Why on earth are interest rates near a 20-year high when inflation is near a 4-year low? It doesn't make a lot of sense. And therein lies the issue. Therein you have a problem. And that's where I think you say people can't buy a home. Mortgage originations are down 75% from where they were on a 10-year average. That's a real problem. And when you can't buy a home, you probably can't get married. If you can't get married, you can't start a family. If you can't start a family, you can't grow, et cetera, et cetera. And so there's real downstream effects.
It fuels on itself.
It fuels. It's this vicious cycle. And think about it. My dad was growing up in the 1960s, and in the 1960s, 50% of 30-year-olds, 50%, owned a home and were married. Owned a home and were married. Now, today, only 15% of 30-year-olds own a home and are married. I mean, that is the most important, depressing statistic today. And so everyone wants to look at the stock market as the ultimate gauge of prosperity in America. That's an important indicator. But I got to tell you the truth. What was really going to matter 4 years from now, what we're going to determine President Trump's legacy on, is how well he was able to turn that trend line around, to get that 15 back up close to 50. People feeling like they have a shot again, that they can own a home, the dignity that comes with owning a home. The number one asset for working class Americans is not the stock market, is not a private equity fund, is not crypto. The number one asset is your home. And you can't have generational wealth if you don't own your home. And so that's what the golden age is about. When we say the Fed is holding back the golden age, they are in effect holding back home ownership. They're not the only drag. Let's got to be completely honest about that. They're a large drag. And if they came off the sidelines and really looked at the data and did the responsible, literate thing, you bring down rates, you bring down mortgage rates, you increase housing affordability, and that allows people to move into homes, to get married, to start families, and to strive for the American dream.
Well, you know, it's not just that. When rates are artificially high, the government has to pay more
That's
money
right.
to borrow, and it's just madness. It's madness to see this. Why is he not cutting the rates? Like, is this political? What is your opinion there?
It is political. It is political for a whole host of reasons. You can think about the proximate and then the ultimate. The ultimate reason we could talk about first is that the Federal Reserve is a deeply compromised institution. They're a one-sided ideological institution. Just look at the numbers. In the 2020 election, 97 cents of every dollar donated from Fed employees, 97 cents, went to Democratic candidates or causes. For every one Republican economist who works at the Fed, there are 10 Democrat economists. If it were the other way around, if Republicans outnumbered in donations and in economists, the Democrats might rightly have a point that this is also a one-sided institution. So the employment, the representation, the donations tell you a story there. And then secondarily, look, the inflation was a lot higher a year ago. And then right before the election, he initiated the largest rate cut in 4.5 years, a 50-point rate cut right before the election, at the meeting just before the election. That didn't make a lot of sense given the fundamental realities of where the economy was and what we call their reaction function, how they are expected to react to price data and growth data, et cetera. And then separately, the chairman, Jerome Powell, has been on a crusade against the president's tariffs. That's a real problem. When the chair goes and gives a big speech at the Economic Club of Chicago in April of 2025, this year, and at the beginning of his speech, it looks like it's going to be an honest assessment of the president's economic agenda. He says that there are 4 pillars of President Trump's economic agenda: trade, deregulation, fiscal, and energy. Trade, deregulation, fiscal, and energy. Of those 4 that he highlighted, not us, he highlighted at the beginning of his speech, he only talked about 1. We know which one we can guess he talked about, which is, of course, trade and tariffs. And so this cherry picking, forget what you want. I mean, you can make an argument that tariffs are good, bad, or ugly. Our research at Azoria has really been out front on this, which is that tariffs have occurred at a time where the president has brought in $150 billion of revenue, a record in the modern era, and then has also done it at the same time that inflation is not at, but below the Fed's target. Headline CPI since the president took office is 1.9%. That's pretty impressive. But separate and apart from that, even if you think that tariffs are bad, doesn't the Fed chair have a responsibility to tell the whole story of the Fed, tell the whole story of the president's economic agenda? And it looks like he was going to at the speech when he said there's 4 pillars, and then proceeded literally to only talk about one of those 4. There's no other mention of the fact that drill baby drill helps bring down inflation, why that should factor into analysis. There's no factor that deporting millions of people who were not supposed to be here in the first place, who pushed up housing prices because they got large stimulus payments, transfer payments, safety net payments to buy those houses, that frees up housing supply and increases housing affordability and is in turn anti-inflationary. And then, of course, lastly, we don't talk about it enough, is the deregulation agenda, which we know is anti-inflationary. Deregulation is at the heart of the anti-inflationary movement. Think about it. Think of all the businesses that never start in a given year because of too much pointless paperwork and too much bureaucracy and too much regulation that says it ain't worth it. Now, when a business gets deregulated, an industry gets deregulated, now you have more people that say, I'm going to start the business. More businesses is more choices for the consumer. More choices for the consumer means lower prices, less inflation. He never talked about any of that. And he didn't have to just pick on tariffs. He needed to tell the whole story. And I think, as I'm doing right now, I'm telling the whole story. You know, my job is to be an investor. I'm, of course, an unapologetic conservative. I'm a triple Trumper, as they say. I voted for the president in all 3 elections. And I got to tell you the truth. I think you can have reasonable, substantive policy disagreements about the president's economic agenda. I entertain those disagreements, so long as they don't descend into panic and histrionic name calling and the utter derangement that we've seen from so many so-called sophisticated experts, from the likes of Paul Krugman and Larry Summers and Justin Wolfers. But at the very least, if you're going to criticize the president's economic agenda, you ought to do it in a way that actually represents the entirety of that agenda, as opposed to selectively picking out parts that you think you can weaponize against him and make the worst possible case to keep rates near 20-year highs, and the harm that that causes for Americans.
So do you think that what will it take for the interest rates to come down? One, the current chairman is finally going to do it. Two, he's going to get fired. Or three, he's going to get replaced in the middle of next year.
Gosh, so let's take those each. You gave three scenarios, and unlike Jerome Powell, we're going to talk about all three. We're not just going to pick one and run with it. I don't think the president's going to fire the Fed chair. And the reason why is I don't think he needs the needless battle. I think that Jerome Powell is already coming around. It's a little too late from a guy, of course, who goes by too late to lower rates. And he's going to lower them in the September meeting next week, but he's only going to lower them by a quarter point. We say 25 basis points in the market jargon. But as you know, it's not about what he does at that meeting. It's about what he signals he will do at the future meetings. So if he cuts by 25, but he cuts reluctantly and says, this is a one and done, we aren't going to do anything for the next 6 months. We're going to wait and see. We're going to sit on our hands. That is a very different story than this is one of several rate cuts, as Fed Governor Chris Waller, who your viewership will know is in the contention for being a Fed chair. He's on the short list. That does change the dynamic a lot. So the president's not going to fire the Fed chair. I do think the president's going to take the advice that of many, including myself, that I've put out there, which is appoint a Fed chair far sooner than anyone expects. So Powell,
Can he do that?
He can appoint him, but he won't be confirmed until May. So Powell's term ends in May. But theoretically, there's nothing stopping Donald Trump tomorrow saying Chris Waller is going to be the Fed chair. Now, why does that matter? Well, because as you know, markets are not about today. They're about tomorrow. They're forward-looking mechanisms. They're forward-looking beings. And so if the market looks at it and says, he's going to appoint Chris Waller, and Chris Waller gave this speech at the Economic Club of Miami 2 weeks ago, where he said that we shouldn't just be cutting, we should be cutting multiple times, that the market is now going to extrapolate, be forward-looking and say, hey, when Waller gets in there, we're looking at 150, 200 basis points of cuts. And the market begins to reflect that, not just in stocks, but remember, the bond market is a forward-looking instrument. The 2-year yield, as an interest rate derivatives trader, the 2-year yield is literally the market's expectation of what the overnight federal funds rate will average over the next 2 years. That's what they mean by the 2-year yield. And so when the 2-year yield is, just for argument's sake, the 2-year yield is 4%, what the market is telling you is, on average, over the next 2 years, the market expects, and that expectation can be wrong, but the market expects that the 2-year yield, the overnight Fed funds rate will average 4% over the next 2 years. And so what you can actually see is the bond market really does the heavy lifting for the Fed. The bond market looks at the Fed, looks at Chris Waller, looks at Trump, knows that Chris Waller is likely to be Senate confirmed, knows that Chris Waller has already made a very credible case for rate cuts that does not appear to be politically influenced, because honestly, the president isn't trying to influence anything. He's trying to make a case that the Fed should look at the data, the same data that we're looking at, that says you need to cut rates not by a little, by a lot, and says, hey, now it's time to bring rates down. I think that's how it happens. I think it's a combination of Powell coming around to a rate cut here and there, but I think it's the president announcing a Fed chair far sooner than the market expects, and that Fed chair being credible, being confirmable, and articulating the case for real rate cuts over the next 12 to 24 months.
Wow. My final question is, do you have any final thoughts? And also, if people want to find out more information about you, where can they find you on social media?
The easiest way is just my name, James Fishback, and then the handle will come up, whether it's on X or Instagram, posting the interviews and my real-time thoughts there. My final thought is, everyone talks about AI and hype, and they complain about the AI hype story and so on. I agree with them. I think there is an issue of AI being dislocated from the hype. I think there's an underhyping of AI versus an overhyping. I think there's an overhyping of certain companies that you probably want to get out of and maybe even go short, that are not real AI companies, that are selling vaporware, and everyone's piling into them because they have a very sophisticated, slick-talking CEO who can come out there and make the case that this is an AI company when it really ain't. But the truth is, this is the most transformative technology. It makes the internet look like a milestone, a small incremental step. And where we will be in 5 to 10 years, it doesn't matter really the company. We can talk about individual companies. Our Golden Age ETF that comes out in a month, the ticker is going to be GAGE, GAGE. That's going to be a really great opportunity to own the high flyers. But I don't think you can go wrong being long the stock market. And for us, Meritocracy, being long the 462 stocks in the S&P 500 that are committed to hiring the best and brightest, who can then effectuate and put in place those AI policies. It's a really exciting time. There's always going to be a macro reason for the pessimist to tell you not to buy. There's always an imminent war with Venezuela. There's always going to be the tariff this, the tariff that. The truth is, this market is one in which you should be buying the dips. The AI story is underpriced. It is underhyped. And there is so much greatness to come. And I couldn't be more excited to be leading an investment firm at this particular moment in time.
Well, thank you very much for doing this.
My pleasure.